Okay, I'm just going to take one quick more sound check just to make sure that everything is coming through all right and that everything can be seen. I'm sorry I had a little bit of trouble this morning with my computer, so I'm on a backup computer, and I just hope everything's coming through all right. Okay, great. It looks like everything is fine, so why don't we begin? And I want to welcome everyone to this presentation on position sizing. This is the 7 Secrets of Money Management program, and this is one of the secrets of money management, which I'm going to go over today and give you a great formula for actually taking the guesswork out of your position sizing. Probably one of the most least observed actions and things that you must do prior to each and every trade. I want to first of all welcome everyone. My name is Steven Primo. I am the president and founder of Specialist Trading. And for those of you who are new to my presentations, I have been trading for roughly 37 years. In just a few weeks, it'll be going on 38 years. I started out on the floor of the Pacific Stock Exchange. My background is really in stocks, but I've traded just about every market there is out there, from Forex currency pairs to futures to stocks to even options. And so what I do now is I take all of the tips and techniques that I've accumulated in my 37-year career, and I teach and mentor all of my students so that you'll be able to really have some sound, basic, fundamental education. It's our opinion at Specialist Trading that the reason why most traders fail is because they're basically guessing and taking themselves out of the game. So you're relying on either someone or something else to tell you what to do. This can be either an indicator, it can be a trading guru, or it can be some trading room or chat room, but either way, it's just having someone or something make the decisions for you. And I say this firsthand because this is the way I used to trade. When I first traded on the floor of the exchange, I struggled tremendously. And I was doing the same thing. I was buying all these programs, going to the seminars, and hoping someone would tell me what to buy, when to buy it. And I paid all this money and attended all the presentations and subscribed to all the newsletters, but I still couldn't make a dime. It wasn't until my mentors actually took me aside and said, Steve, you have to become a part of the process and take the guesswork out of your trading, that I started to become consistent. So this is what we teach and mentor all of our students. Even though we have strategies that generate signals for you, it's more about teaching you these strategies so that you can ultimately spot the setups on your own, and you won't have to rely on anyone or anything to tell you what to do. That's where you really start empowering your trading and hopefully start to get onto that road of consistency, which I know so many traders are searching for. Now, before we begin today's presentation, as always, I ask that you please take a moment to view our disclaimer. I'm going to show you a lot of performance results using this technique and this formula for determining your position sizing. But please remember that we can in no way guarantee that any of the results I'm about to share with you will be repeated in the future. So please take a moment to view our disclaimer. And also, while you are looking at that, I would like to invite each and every one of you to visit the microsite that FX Street has so kindly put together for us. This is the site that gives a lot of free, valuable information about myself and actually what we offer at Specialist Trading. If you see there in blue, just below FX Street, this is the link. It's a little bit complicated there to copy and paste all that down, so we've abbreviated it to the lower link on the bottom, okay? http://bit.ly/06mgv0. Okay. Now, once you go to that microsite, here's what you'll find. You'll find more information about the strategies that we offer and the different courses. Remember, these are more like mentorships or more educational courses where we do give you strategies and ways in which to trade, but we give you a lot of information so that you can empower yourself, and also some more information about myself as well. So a lot of great free information there, so please go to the microsite that FX Street has provided for us. And also, I want to invite each and every one of you to follow us on Twitter. That's our handle right there, at SPCLSTTRADG, abbreviation for Specialist Trading. I post free daily information, anywhere from signals that we are currently in to actual daily financial wisdom, things that you can learn from. I posted just last week, at the end of last week, a great indication of a trend change in the overall market. So there's a snapshot there you may want to look at. We also, I haven't posted yet, but it looks like we may be getting a long signal in one of our proprietary strategies in the euro yen. So after this presentation, I may be posting that as well. So you have advanced warning on that. I just have to check the charts after we conclude this presentation. And there may be actually a buy setup on the euro yen. Now, we don't give away the entries and the exits. That's for people that are members and students of mine. But at least you'll know what positions we are currently in. So once again, feel free to follow us on Twitter. A lot of great free information that I post on a daily basis at SPCLSTTRADG. Okay, so once again, I want to basically share with you what I learned trading on the floor of the exchange. I know a lot of people will think that, boy, when you were on the stock exchange, you must have made tons of money, and it's easy for you to talk about being successful because you were basically born with a silver spoon in your mouth. That's not true. My first year or two, I didn't think I was going to be trading much longer because I couldn't make a dime. I was doing all the things you're supposed to do. I was reading all the books, going to the seminars, buying the newsletters. I had tons of indicators and everything plotted on my screen, listening to all the news, and I still couldn't make a dime. So I know a lot of you may be going through the same situation yourself. You know, you're attending all the webinars, you're in the chat rooms and the trading rooms, and you have nothing to show for it in your trading. I can commiserate with you because I know exactly what that's like. I went through a couple of years of that. I finally was able to meet a couple of my mentors on the floor. These were actual traders themselves who have been trading for about 40 years, and they really shared a lot of insight and different ways in which for me to change my trading and to get on board and become consistent. And so what they taught me is what I teach and instruct in all of my students. So what they shared with me most especially were some secrets about money management. I think everyone agrees what money management is. They have a different idea or a different inclination of what it should be. But here are some more insights into what money management is. First of all, in money management, it should be non-subjective. So in other words, you shouldn't come to some scenario where you're in a position or thinking about getting, and you make a guess as to what you're going to risk, how many lots to trade, where you should be getting out, how large your account size should be. It shouldn't be something that you come to on a daily basis and you're just kind of guessing as it goes along. And also, money management is a process. It's not something that, you do once and then that's it. It's a turnkey type of scenario. It is something that should be consistent. It's something that you follow on a daily basis, just like brushing your teeth. You don't just brush them once and then that's it for the rest of the month. It's something you have to do once, twice a day. It's something that you should be consistent in order to be healthy, and same way with being healthy in your account. And then lastly, it should be as simple as possible. I know there are a number of different money management techniques where it's, the logic is so convoluted. There are 1,000,001 rules. And this isn't even getting to the strategy itself yet. We're not even talking about where you're going to buy or sell. This is just the money management rules and the money management requirements. So it gets to be way too complicated. And there's so many requirements that need to be met. Pretty soon you can't even get into a trade because none of the requirements weren't met. So it's just so complicated. So remember, money management should be non-subjective. There should be no guesswork involved. It should be consistent. It should be something that is done on a daily basis and should have daily consistent results. And we don't mean that you're going to have results where every trade's a home run. It just means that it's going to keep you in the game, that it's going to protect you. This money management is going to protect you, and it's going to make you or help you to become consistent. And lastly, once again, it should be as simple as possible. It shouldn't be something where you need a mathematics major in order to calculate or to hold down the fort. And lastly, and this is, I think, what is really at the core of everything that we have at Specialist Trading, is that it should make you a part of the process, okay? It should not be something, once again, where that you are simply, an observer. You're not involved at all in the process. You're not doing anything. You're just kind of on the sidelines and you're saying, well, just tell me what to do and I'll do it. I have no idea why. No, you should be a part of the process with your money management. You should have an active say, and this should transfer over into your trading as well. So these are extremely important things. They should also be a part of any category in your trading, okay? All right, so we're going to be talking about secret number 3. We have a great course at Specialist Trading called the 7 Secrets of Money Management, and I'm going to share with you and give you all the rules to secret number 3 as it applies to Forex currency pairs, all right? Because I was taught, once again, 7 secrets that will really help to sustain my trading through money management. And I'm sharing with you secret number 3 of the actual program, one of our most successful money management programs we have at Specialist Trading. All right, here's secret number 3. As we just stated, never ever use discretion when deciding your position size. All right, so I'm sure a lot of you would say, well, I don't do that at all. Look back and ask yourself, really, do you or do you not use discretion? So many traders that I've talked to and mentored and have studied under me, when I ask them about how much is their lot size going to be, how many shares or contracts, how many futures contracts, whatever they're trading, they simply decide that day. And it usually has to do with how well they've been trading. If I've been trading well, a lot of people are different. A lot of people would like to, bet the bank. They say, I've been doing well, so I'll bet my entire account. Where other people are different, they'll say, I've been doing well, I'm kind of scared. I don't want to give it all back, so I'll really start, trading with a smaller size, okay? And it's all discretionary. Other people will wake up in the morning and say, boy, I have a really great idea what I think this market's going to do with this currency pair, and I'm just going to bet the farm. Other people will wake up and say, you know what, I'm just feel kind of doubtful or frightened today. I saw some news report last night. It's kind of scary. I think I'll just wait and maybe bet, the smallest amount possible, because it really is a bet in their minds and their mindset. They're not investing. They're not trading. They're not really coming in with any discipline. They're just using discretion as if you were at the crap table and saying, okay, how much am I going to bet? Or if you're playing cards, how much am I going to bet on this hand? And this is just totally discretion. It's just no different from guessing. And this is the way I would say the majority of all traders decide on their position sizing. Ask yourself, when you decide on a position size, what are the factors that come into saying how many lots you're going to be trading? Okay. For example, let's look at this trade. This was an actual strategy setup in one of our proprietary strategies. This is an older chart in the Swiss franc. And by the way, I'm going to be sharing with you a lot of older charts. Don't worry. This technique I'm sharing with you today really has nothing to do with the recent validity of a chart. It's more about understanding the formula as you can apply it. So I'm showing you older charts for educational purposes. So this is an older chart of the Swiss franc. And this was an actual signal that was generated by one of our strategies where you would have entered here, okay? And you would have entered to go short. Now, you would have had a very nice trade, okay? You would have a very nice trade. Here's the difficulty in this. Would you have been able to capitalize on that? Would you have had 1 or 2 or 3 contracts? How many lots would you be trading with, okay? Could you really capitalize with only 1 lot, or how about 2 or 3? In other words, what if you had a loss on the prior trade? With 1 contract, now you're back to breaking even, or you still have a minor loss. With 2, possibly you broke through your losing percentage, and now you have a small profit. With 3, perhaps you have a large profit. But how do you decide? Well, this is what I'm going to be sharing with you today. This is secret number 3. This is the RPS method. I was introduced to this on the floor when I was working on the exchange through my mentors. And what it is a simple mathematical formula that automatically decides how many shares or lots to trade. I mean, it's how much simpler can it get than that? You don't have to guess. You don't have to wake up in the morning and say, boy, there's some news report or the market's really been volatile. I better cut down, or I don't know how many lots to trade today. Well, this will automatically decide for you and will keep you in some type of restrictions or requirements for the money management principles. All right, so here's what we want to do. We're calculating the risk with our percent of capital. So that's what we're doing right off the bat. And so we want to calculate how much risk with the percent of our capital. By capital, I don't mean how much we're investing or applying for that one trade. I mean, a capital means in this reference, your nest egg. How much do you have to trade with? In other words, if you have to look and get a lump sum of what you've allotted yourself, what do you have to trade with? $5,000, $10,000, $2,500? What is your amount of capital to trade? Capital does not mean how much you've put into the past trade or the last trade. So you must start with an adequate amount of capital. Once again, this changes from trader to trader. We would say if you are, trading, the mini contracts of any currency pairs, anywhere from 2,500 to 5,000. We would say if you're trading the large currency pairs, it would be somewhere from 5, 10, maybe even 15 would be more optimum. And then if you're holding positions overnight, swing trading, holding things for a much larger period of time, anywhere from 25 to 50,000. Okay, but this once again has mainly to do with what type of strategy you're using, how long you're holding positions overnight, if you're intraday trading or not. So once again, be honest with yourself in deciding. If you like to hold positions overnight, you can't do that with we believe, with a $2,000 account or a $1,500 account. Also, if you want intraday trade, you don't necessarily need $50,000. You can have a much smaller account. So go in and research and see what type of trader you actually are. But you must, once you decide what type of trader you are, you must have adequate amount of capital. Next, we want to decide on how much of a percent of this capital we're going to risk per trade. So in other words, if we have $50,000 or we have only $1,000 or if we have $100,000, the benchmark is 2%. And I know you've probably all heard that before, but most people don't stick to it. So you should only per trade risk 2%. And we'll get into this a little bit further on in the presentation today. But remember, when we say capital, we're not talking about, well, I'm risking 2% of how much it cost me to purchase this trade. No, we're talking about 2% of how much your nest egg is. So if you have $100,000 sitting in your account, you can only risk 2% of that. That's the benchmark. We would say at the very most you can risk is 3% of your entire capital amount, the very most. And you should try to work to risk just basically 1%. I only risk 1% of my capital. That's what you should be striving for, because this will keep you in the game a lot more. Now, conservative traders, if you're extremely conservative, you really like to, know exactly where all your money is going, you can also include slippage and the spread, in other words, within this. So this is if you're really conservative, you have to determine this before you get into the trade. Conservative traders can include what they think they may miss on the spread size or the slippage within that. So it's up to you. Okay, so let's talk about the Forex, since we can apply this to any market. We can apply this to the stock market, the futures market, the E-mini futures, but we're going to be talking about Forex today because as it applies to FX Street, and mainly most of you, I believe, are currency pair traders. So we're going to show you how to use the RPS method with currency pairs. And by the end of this presentation, you'll be able to start applying this as early as today. One thing I forgot to mention, I'm sorry, as I said, I had to kind of start late here because I was transferring everything up to a backup computer, which I hope is still working fine. But please remember that if you have any questions, kindly wait till the end of the class. We'll probably conclude here in the next 15 or 20 minutes, and then we'll reserve the last 15 or 20 minutes for questions, okay? So I really appreciate it. If you happen to have a question, just kindly write it down or try to remember it, and I promise we will get to each and every one of them in the last 15 or 20 minutes. Okay, so here is the position sizing formula, and please remember that this may seem a little wordy, it may seem even very confusing. Don't worry, once I start showing it with some chart examples, it'll make a lot more sense. And I believe that FX Street does record these presentations, so if you aren't able to copy all this down or it doesn't make sense, I believe there will be a recording of this later on. You can contact the good people at FX Street, and they can tell you when this will be made into a recording. All right, as we stated, rule number one, you want to determine the 2% risk amount of your capital. Once again, when we say capital, we're talking about your entire nest egg. We're not just talking about how much money you put into the last trade. We're talking about what you have to work with, all right? Next, you must decide your stop placement, okay? There are so many traders that also come into a trade with no stop in place. They don't even have an idea because they come in thinking that every trade is going to be a winner, so there's no reason for me to think about stop. I'll get to that road when I cross it. That's not what we're going to be doing here. You have to know before you even get into the trade, where is your stop going to be? It could be the recent high, it could be a most recent low, a pivot high or a pivot low. It doesn't matter, but you need to know in order to put together this formula, you need to know where your stop is going to be or where you're going to be stopped out if the trade is wrong, if it is a faulty trade, all right? Why? Because we go to rule number three. If you were stopped out, what would be the total dollar amount lost per contract, per one lot, okay? And once again, this may get a little confusing, but don't worry, it'll make a lot more sense when I show you some charts with it. But that's why we need to know what the dollar amount would be per contract, per lot, per share size, whatever we're trading, if we got stopped out, all right? Now, what we want to do is we have, two figures now. We know the 2% amount of risk, and we know the dollar amount we would lose if we got stopped out. What we want to do is divide whatever that 2% dollar risk is by the total stopped out dollar loss. Okay? We're going to divide whatever our 2% is of our capital by how much we lost in a dollar amount. And we'll round off to the nearest number, and this will give us the proper position size. This is how simple it is. I know it seems wordy, and I know you're probably thinking, boy, I can't do this before every trade. Steve, I day trade. I need to know in seconds. Trust me, I day trade too. And when I first got this formula from my mentors, I thought, there's no way I can put this together. I've been doing this now for over 30 years, and it takes me maybe milliseconds to put together because I'm so familiar with it. So practice makes perfect. It's very simple to practice and put together. You can in less than a couple of seconds, you'll know exactly what your lot size should be after a couple of weeks of practice. Okay, so let's show this formula now, okay? After all, it's called the RPS formula. What does that stand for? Well, R equals the 2% risk amount of your capital, okay? So R simply equals how much you're risking. Remember, not on this particular trade you're in, not how much it cost you to purchase this trade, whether you're long or short. No, it means the risk amount of your entire capital. If you have 100,000 to work with, or if you have 10,000 to work with, you're only going to be risking the benchmark 2%. Remember, at the very most, it can be 3%. You should strive for 1%. Okay. All right. So that's what R equals. P equals the pip dollar loss if you're stopped out. So in other words, you're stopped out with 100 pips. What's that going to transfer over into dollars per one contract, per one lot? All right. We're only looking at it as if you had one lot or one contract. And then you simply divide R by P, as we see here in the lower demonstration at the very bottom, and that will give you the size or the number of lots to trade. That's how simple it is. R divided by P equals S. Now let's take a hypothetical example here to make it even more simple. Just to make things simple, because I'm not that great at math myself, here's example number 1. Let's say you have a $100,000 account. Okay, that's your nest egg. That's what you have to work with every day. You have $100,000. Okay, so R equals 2% of that. What's 2% of $100,000? $2,000. Okay, so if we see here, R equals 2% risk dollar amount of capital, or $2,000. All right, now we go to P. P equals the pip dollar loss if we were stopped out. So if we had one lot, let's say we already have a trade set up, we know where we're going to buy, we know where we're going to get out if we're stopped out. How many pips would we lose if we got stopped out? Well, in this example, once again, just to keep things simple, let's say we would get stopped out with a 100 pip loss, all right? And in this example, for all intents and purposes, 100 pips would roughly equal $1,000. Okay, so we would lose 100 pips. What does that equate to in dollars? $1,000. So we simply divide R by P, or as you see here, 2,000 divided by 1,000 equals 2. Guess what? That's how our share size, our lot size, I should say. That's what we can trade with. 2 contracts, 2 lots. That's it. It's that simple. And it's really easily done, once again, with a little practice. This is not something you have to, boy, it's going to take me half an hour to figure this out before every trade. I don't have that much time. No, you'll see how easy it is. You'll know exactly roughly how much you have in your account to work with. Once you figure out where the trade entry is and where you're going to get stopped at, you simply calculate the dollar amount and divide R by P. It's that simple and that quickly done. All right, what if we change the account size? Here's example number 2. Let's bring it more down to earth. Let's say we have a $20,000 account, okay? $20,000. R equals 2% of that. What is 2% of $20,000? Well, it's $400. So R equals 400 right here, okay? P equals the pip dollar loss if we're stopped out. We're going to use the same trade scenario. We're going to use the same area if we're stopped out. We're stopped out. We're still going to lose 100 pips. What does that transfer dollar-wise over into one contract? It's $1,000. Okay, so P equals 1,000. So we divide R by P. 400 divided by 1,000 will give us a size of our number of lots to trade, and it's a negative number, negative 0.40. So basically, this is telling you you can't take the trade. Do you see how this great methodology or formula is keeping us in the ebb and flow of how much we can risk, what our account size is, and it will change as our account grows larger. We'll have more to use per trade because 2% will increase with the account size increasing. And then we will be able to go into these ebbs and flows here. Possibly we can go down to 1%. But as you can see here, this is a great example of how if you had a larger account size, you could take the trade, and it automatically decided for you. If you had a smaller account size, well, you couldn't take the trade. Now, let's say this trade turned out to be a loser. If you had the original $100,000 account, that's okay. You've only lost 2% of your particular account. But if you had the $20,000 account, okay, 2% of 20 is 400, so you've already lost close to 5% if you took this trade. And this is the way most people will trade. They'll say, well, I only have $20,000, but this is a great trade. I don't think I'm going to get stopped out, so I'll just trade one lot. And if you did get stopped out, you lost 5%. Now that we're over the threshold, we're way over the threshold. And if you do that enough times, pretty soon you've lost 20%, you've lost 30, 40%. Now half your account is gone. And this is the way most people trade. This is why so many traders wind up in that 80 to 85 percentile group where they ultimately fail. And a good deal of it has to do with position sizing. So in this particular setup, with its account size, with how much you're planning on risking, you cannot take the trade. All right, so let's look at an example here with the euro dollar, okay, just to make sure that we can apply this to actual real-world trading. Once again, as I stated, these are older charts. These are not current, but they're for educational purposes. We're not trying to share with you how a strategy performed or how well it did. We're really trying to share with you and implement this formula so that you can understand how to apply it, okay? So let's put this together. Let's say, once again, to make things simple, we have a $100,000 account, and we're trading the euro dollar. Now, we get to decide what our R is. Obviously, R is going to be 2% of $100,000, so R equals 2,000. All right, so we can do that before we even have the setup. Before we even know where we're going to be buying or selling, we can know exactly what R is always going to be because our account is just static and we know what 2% would be. So now we see a setup through one of our strategies where it tells us to enter long here if we trade right at the old high, okay? And remember, we're not going to just simply buy and with a couple of lots without throwing caution to the wind. We have to decide, first of all, where would we be stopped out in this trade? Where's our stop loss? And let's say our stop is right here, halfway through that setup bar, okay? Before we enter, we have to determine how many pips are we going to lose. We're going to lose 100 pips if we get stopped out. And what does 100 pips transfer over onto dollar-wise in the euro? Well, that transfers over into $1,000. So P equals $1,000. In other words, if we got stopped out with one lot, we would lose $1,000. So what's the formula call for? We divide R by P. 2,000 divided by 1,000 equals 2. So we can trade this with two lots. So now it took me, less than a couple of minutes just to describe that for you. So now you know you're in the trade. You can, if we trade up to your level, you can buy the euro dollar, and it would have been a good trade. You just made a couple of hundred pips in the next week, and you had two lots. See how simple that is. Let's go forward and ask ourselves, what if we used a different stop? Are we still going to be able to trade two lots? Well, remember, that's the beauty of this formula. It changes with the ebb and flow of your account size, of where you're going to place your stop, how much you're going to be risking. So there's a lot of things to determine here. So we have the same $100,000 account. We're still looking at the euro dollar. Nothing has changed in terms of the 2% or our risk, which is R, because we're looking at a static $100,000 account, 2% equals 2,000. And where would we enter? Well, we enter at the same place, but now we're going to change our stop. Where would our stop be now? Well, our stop would be down here. In other words, we want to give ourselves a little bit more room. We're taking stop placement number 2, meaning that we're giving ourselves a little bit more room, a little bit more risk, but we want to give ourselves because we feel there may be some volatility. We don't want to get stopped out. Perhaps we're scared about some report coming out or what's going on in the world. Either way, this is a valid stop as well, but you would more likely want to take this one. Okay, now if you got stopped out, how many pips would you lose? If you entered at the designated entry point and you got stopped out right away at the designated stop loss, what would you lose? Well, roughly you'd lose 200 pips, okay? So now we have to ask ourselves, what does 200 pips transfer over onto a dollar amount per contract? Okay. Well, if we're trading the euro dollar, we realize with currency pairs, it trades with each and every currency pair because of the different price fluctuations. But with the euro dollar, we know 200 pips would equal $2,000. So now we have P. We simply divide R, 2,000, by P, which is 2,000, and that gives us 1. So this means with these new parameters, with the same account size, with the same risk parameters, but with a larger risk, meaning that we moved our stop lower and gave us more room, this means we can only trade 1. So where before we had a nice trade to the upside with 2 lots, well, now we only had 1. But remember, this is looking at a positive way if the trade worked out. But what if the trade didn't work out? That's what money management is. It's trying to protect and preserve our capital. And this is, I think, is the best way I know of how to do it, by controlling your position sizing. All right, now, once again, you should strive to only risk 1% of your entire account. All right, that's what most hedge fund managers, most professional traders really risk, only 1%. Most of them actually risk less than that. So let's look at that same scenario once more. If you have a $100,000 account, R now will only equal 1% of that. So 1% of 100,000 equals 1,000. So that's how much you're going to risk per trade. That's not how much. Remember, this is where people have confusion with this. It does not mean how much of your account you're using for a particular trade. It means if that particular trade got stopped out, that's the most you're going to risk, $1,000, I should say, of the $100,000. All right, so we look at the same setup again. Here's our same entry if we trade right there at the old high. And here's our stop. Okay, we're going to give ourselves a lot of room because we'd like to, make sure that we're in the trade. We don't want to get stopped out too early. All right, so if we enter at the designated entry and get stopped out where our stop place would be, remember, we have to figure this out before we even enter into the trade. Well, we're going to, once again, lose 200 pips. 200 pips would transfer over onto $2,000. So, therefore, R, which equals 1,000, divided by P, which equals 2,000, would come out to basically a negative number again. We cannot take the trade. Why? Because it would give us a negative number. It doesn't come out to a positive, round off to a positive number. So with this, with these parameters, with this $100,000 account, but only risking 1% and having the stop where it is, we cannot take this trade. So you see how one scenario would have had us trading with 2 lots, another scenario had us trading with 1, and then even another one had us not trading at all. So this is why it's important to experiment with this and see what guidelines best fit you. Now, we're not saying to alter everything. In other words, if you say, well, okay, if I have 1% and I want to take this trade, but it doesn't allocate me any lots, well, I'll change it now to 2%. This does not mean that you can go back and form fit how much you're going to risk. You can't say, well, now I think I'll risk 5%, therefore I can take the trade. That's not what this is meant for. You have to stick to risk parameters. You have to stick to a stop placement. In other words, you can't change the stop just to allow you to take the trade. If it's a valid stop placement, you have to stick to it. If the strategy calls for the stop at that particular place, you have to stick to it. You can't just alter and edit things so that you can go to the card tables. So let's review here. Secret number 3. Always remember that your trading is adequately capitalized. Now, this it goes without saying. This is not something that we can tell you that is a bona fide number. This is something you're going to have to really research and feel comfortable with. But please, if you're intraday trading where you're in and out, all right, granted, you don't need a $100,000 account to do that. But we would say at least anywhere from $5,000 to $10,000 would be even more optimum. Now, if you're trading where you're holding positions overnight for maybe days, weeks, maybe even months, well, a $10,000 account is not going to cut it because you may have some losses there if you're taking some big sizes. So you have to really be honest with yourself, okay? We would say anywhere from a $15,000 to $25,000 account is perfect for both worlds, especially with our strategies. It fits in very nicely, okay? The barometer that you want to risk per trade should be 2%. This means 2% of your entire capital, whether you have $100,000 or whether you have $10,000 to work with. That's your entire capital. You should only per trade risk 2%. That's the benchmark. At the very most 3%, but you should strive to only risk 1%. Okay? Find a technique, find a strategy that will allow you to have some high probability setups where you only have to risk 1%. This is what, like I said, this is what I risk on a daily basis with my trading, and our strategies fit that perfectly. Remember that the RPS stands for a simple mathematical formula, but it must be used prior to every trade. R means the risk of your capital, P equals the pip loss transferred over into dollars, and S equals your size. So R divided by P equals S. But you must be diligent. You must use this prior to every trade. Please never go into a trade thinking that, well, I've just had 5 winners in a row. I'm going to bet the farm on this one because I can't lose. I'm so hot. Whereas others may say, I've just had 5 winners in a row. It's got to end pretty soon. I'm going to really keep my account size small. I'll only trade one lot or just not even trade at all. I won't trade because it's got to end. You see, that's all discretionary. It's all coming off of fear or ego. And that's not a way to decide on your position sizing. The beauty of the RPS method is that it automatically decides how many shares or lots to trade. Okay? And the edge here is by adding structure to your, I should say, to the money management, you take the guesswork out of position sizing. So all we've done is add a little structure. It doesn't, control you. It doesn't tell you on every trade what you should be trading, but you put in the parameters. You plug in how much account size you had. You plug in how much you want to risk. And then this structure will take the guesswork out and give you the proper position sizing. Okay, so secret number 3, once again, never ever use discretion when deciding your position sizing. This is a recipe for disaster. I know firsthand because I used to trade this way, especially when I first started out. And, you would be riding high in April and then shot down in May. You'd be doing fantastic. And then because you weren't controlling your position size, eventually it would come back to take all your profits away. So we need to add this structure so that you'll be using sound money management in your position sizing. Now, this was secret number 3. As I stated earlier, this is part of a 7-secret course, the things that were taught to me in my beginning stages of trading, and we put together in a great course. If I could just take a minute to talk about it, it's called our 7 Secrets of Money Management course. 7 different videos. Here's what you'll receive in the 7 Secrets of Money Management course. Secret number 1 is the true meaning of money management. We tell you what we really feel, but is the true meaning and what most traders and educators get wrong. Secret number 2 is we talk about preliminary stops that probably you have not used before in any of your trading. Secret number 3, well, guess what? We just shared with you. We didn't go in detail as much as we do in the course, but we shared with you the RPS method today using for currency pairs. In the course, we talk to you how to apply some higher levels of the RPS method. We also tell you how to apply it for futures as well as stock market. Secret number 4 is trailing stops. We have some proprietary techniques that I don't think a lot of you are familiar with that we use for staying in a trade a lot longer. Secrets 5 and 6, we go into the basics of money management, which are risk-reward ratio. We tell you how to increase your odds for risk-reward ratio with these 2 simple techniques. They're part 1 and part 2. And then I think the most important part of money management course is secret 7, which is the ATM. That stands for automatic, or I should say, I'm thinking of ATM, the automatic teller machine. It's automatic trade management. And it's designed to keep you out of a drawdown while you're currently trading the strategy. Let me show you what we mean here. Because every strategy, every technique will go into a drawdown every once in a while. All right. The key is to know when a drawdown is beginning and when you just have a small little pullback in your P&L and you can still trade. What the ATM does is that it senses when a large drawdown is happening in your trading and it gets you out of the market, okay? Or it keeps you in. Here's a perfect example. This was the actual equity curve of a student of ours who was trading one of our Forex currency pairs, strategy number 5, I believe. And this was just on the euro dollar, okay? And as you can see here, this is a very nice P&L for the first part of this chart. It was having this 2 steps up, 1 step back approach, and it was doing very well. And then ultimately the strategy kind of hit a snag, and what happened was it just went out of sync with the current market environment and unfortunately went into a large drawdown. Now the beauty of the ATM is that it will only keep you in while the market is rising. And once it senses that it's starting to head south, your P&L is starting to head south, it will take you out of trading and say, stop trading. That's the beauty of this method. Great money management technique. Once again, this was introduced to me on the floor of the exchange. It has literally saved me thousands, if not hundreds of thousands of dollars by telling me when it's okay to trade and telling me when not to trade a particular strategy. So all this comes in the Secrets of a Money Management course. Remember, detailed instruction, 8 videos, 6 stop placement techniques, the RPS method in more detail, which we just shared with you, different techniques for risk-reward ratio, the ATM method, which we just explained, and also access to my personal email. As well, there is an FX Street discount for all the people, but only for a limited time. So remember, once again, please go to the microsite that FX Street has so kindly put together for us. There is the abbreviated link on the very bottom, and it will take you to this page where you'll learn a lot more about myself as well as the strategies that we have for all of our members. Okay, I want to thank you so much for holding off on any questions, and I hope we didn't have problems with this computer. I just want to make sure that you were seeing and hearing everything okay. Let me just open up the chat box if I could, and I want to thank you for waiting. If you happen to have any questions, now is a good time to ask. If not, I leave you free all now to go and start using the RPS method and start applying it so that you can take all of the guesswork out of your position sizing. Remember, please feel free to ask any questions right now if something didn't make sense or you forgot how to do it. And the main thing I want to stress is that when you take yourself out of the game, whether it's in a strategy or whether it's in your money management, you're really giving your power away as a trader. As traders, we're supposed to make our own decisions. We're supposed to know and accumulate all the facts and all of the different bits of information, but then decide for ourselves what we want to do. The worst thing you can do, in our opinion, as a trader, is to just kindly buy or sell something because someone else told you to. They have a great, that if that's works so well, then 80% of all traders would be profitable. But unfortunately, it's the opposite. But with the advent of so many trading rooms and so much people relying not on education but on a program telling them where to buy or sell, you see that traders are just taking themselves out of the process. So our goal is to make you a part of the process. I don't want many of my students to rely on me to tell them what to do. Once again, we furnish them with strategies, with signals, but they're for educational purposes so that you understand what to look for on your own. And then ultimately, you can just trade on your own. You don't have to rely on anyone or anything. That's really where you'll get on that road to consistency. So that's our goal at Trading. Once again, for any more information, you can go to our sister site, which you see right here in front of you. That's protraderstrategies.com. They market and promote all my courses, the 7 Secrets of Money Management, as well as any trading courses, strategy number 5, our most consistent strategy for trading the currency pairs. You can email them at trading@protraderstrategies.com or call them directly at area code 310-598-6677. And I see that the good people at FX Street have posted up a link as well. That's our microsite link where you can go and just simply click that on and you'll find more about that. Okay, if there are no questions, I leave you now to use the RPS method. Remember, to practice this, don't just jump in and say, boy, this is fantastic, I know exactly how to use it. You have to practice it just to make sure that you understand the entire process. So feel free to paper trade with it and see if it could really help you. But we always want to give people in our presentations with FX Street one bit of information, educational, so that they can use for free, so that you don't have to feel that every time you come here you're just being suckered into buying a product. We like to leave you with some bit of information that you can start using as early as today. So I hope it helps. I look forward to seeing you all again next month, and I wish you all a happy new year and happy holidays. Thank you so much to everyone for attending. Thanks to FX Street for giving me the opportunity to speak, and we'll see you next year. Bye-bye.